Okay, so we have two lows here that are relatively equal. And you always want to put it right on the lower of the low between the two. So that's, I'm a little bit below it, that's okay. But from here and here. So what's resting below that? Sell side liquidity, sell stops. Traders that would want to protect a long position, they put their sell stop below that. Traders that want to sell short on a breakout, thinking that weakness that comes in, they would see that as what? A reason to be short. So if what I'm teaching you is we attack that liquidity. And the question that comes up a lot is, okay, how do you know how far if you want to be buying these stops? Because I teach how to do that in the core content that was uploaded last year on my YouTube channel. And folks, please stop emailing me asking me to join my paid mentorship. I'm mentoring you right now for free. This is mentorship. Okay, I don't want your money. I'm never going to charge your money. This is it. Okay, I mean, I'm having fun doing this. You should be keeping notes and benefiting from all of it. But the question many times comes up is, you know, how can you trust? How do you know? How do you know then when it drops below old lows to be a buyer? How do you know how far it can go? Like, where would you place your stop? Well, in this case, this helps a lot when you have information like the new week opening gap, because we would expect it to drop down. This was in the chart. It wasn't off screen. It was mentioned to you that this is an interesting level. If we drop lower, this is where it's going to likely draw to. It's below these relative equal lows. So below here is sell side. So there's layered sell stops below these lows that you don't know. And the depth of market, the DOM, those orders can be spoofed. Just because you see them prompting you, saying there's this many willingness to be a seller or a buyer at a particular level, doesn't mean that that order is going to be there when price gets there. Spoofing is a real thing. Spoofing is where they put an order there, and then by the time it gets close to it, they pull the order away. So it's a gimmick. Okay, I'm sorry if you like to use that tool and it's helpful to you, that's great. But don't argue and say that that's the reason why the market's moving around, because it's not. But below these lows, there's sell side. So how far can it drop down below old lows? New week opening gap, new day opening gap, opening range gap. There's your three tools. How far can you trust a move above an old high for a turtle soup? I just taught it to you. Oops. Magic can come out of nowhere, can't it? So the market drops all the way down through relative equal lows into some random level, new week opening gap, goes one tick outside of it. Why? Remember what I was teaching you? It likes to create these little mohawks, okay? These little mohawks that overlap a little bit. Why? Because there has to be what? The bid and ask difference. So if a trader wants that 39.74 and a half, it has to trade where? 39.74 and a quarter. And that's what you got here. Everything makes sense when you understand it that way, instead of taking your price patterns and animal harmonics and Elliott wave things and try to cram all that stuff into a reason why price is going up. It has no reason. There's no basis at all for why the markets are going to be booking this way. It's going to go up for buy stops, or it's going to go up to redeliver to an inefficiency like a fair value gap. That's it. It's either going to go up for that reason for longs to sell their long positions too, or it's going up there to start a new sell-off. So that way shorts can be implemented, and then it's going to be looking for an opposing liquidity. The market goes down for sell stops. It goes below an low or an old lows, where it goes down to an inefficiency that it will reprice to. That's it. If it's not doing that, guess what it's doing? Consolidating. Is that hard, folks? I get complaints all the time from people that don't really want to learn. Or they sell something. They have a competitive nature because they're trying to sell their thing. And I'm out here teaching you what makes the market really move, and it's booking perfectly to a tick. And they'll say, I'm overcomplicating things. I'm not complicating anything. That is absolutely easy. It's totally three conditions. It's going up for one of two reasons, going down for one of two reasons, or it's consolidating. I teach you when it's going to consolidate. When we're ahead of big news or event like this, we don't know what Powell's going to say and how the market makers are going to utilize that. So what is it doing? It's consolidating. We're not trading. Why? Because it's likely to do this. And if it does move, it's uncertain. So you can't really trust it. So there you go. Now you know when the market's going to consolidate. I just taught you. I've taught you before, but I just reminded you this is what it looks like. But when you're bullish, and when I'm bullish, I'm looking for one of two things to happen. It's going to go up to buy stops above a high or relative equal highs. Or it's going up to a premium fair value gap, some kind of inefficiency where the market has dropped in the previous, I don't know, it could be as far as 60 days back. Some old high, some old price decline where there is a fair value gap. It's going to go up into that level there to reprice. That's the only two reasons why price is going to go up for me. That's it. It's simple, isn't it? It's very, very simple. That is not complicated. No matter how much you want to torture it, it's never going to submit to being complicated. That's easy. It's going up for stops or it's going up for a fair value gap. Boom, done. Over. Simple as that. Are you bullish? Okay, you're looking for one of two things. Is there a fair value gap? Nope, there ain't no fair value gap. So what's it going to go for? The stops, baby. It's going to go right up into those buy stops. Just like you're seeing it happen right there. Is it complicated when you look at it that way? Honestly, I'm asking sincerely. Because I don't believe it is. I don't believe it's complicated. It's very simplistic. And it's nothing that you should be wrestling with and trying to feel overwhelmed with. But you're trying to learn it too fast. And you can't rush it. It takes these types of things here, sitting here and watching price action. When we were down here, I said, watch that wick. Okay, that's not cherry picking. That's me taking your attention right to a very specific price level. Not a zone. Not a zone. A very specific price level. The midpoint between the closing price and the low of that candle is consequent encroachment. And I told you, as this candle was dipping down in here, I said, watch that level right here. And then I said, we want to see what? We want to see it trade back above, deeper into that 60-minute fair value gap, which is that pink shaded area. And more specifically, aim for the buy side liquidity resting above here. Why? Because we've already worked and utilized this fair value gap multiple times. So if it's going back up here, it's not going back up here for this. It's going back up for what? The buy stops resting above that. Is that complicated? Was that complicated at all in my delivery about it? It's not complicated, folks. Think about what's going on here by doing that. I'm stating that the algorithm will go back down to this level, below these lows, go there, and be content with that, and then look to do what? Reprice for an opposing liquidity or inefficiency. We had both, buy side and the remaining portion of that 60-minute fair value gap in the shaded area. I don't need it to go all the way up to the top. I just needed to go back to the buy side here. So smart money was buying below these lows. Notice it's doing that when it goes down here. This area here, which is the midpoint of this wick. Let me go back in case you guys just showed up. We were looking for this new week opening gap down here. It delivered it at 39.80 and 3/4. It came down to 39.50, 39.80.50. That's the low. Look up here in the upper left-hand corner. That candle's low is 39.80.50. One tick below consequent encroachment. That is below this low and this low. So the algorithm is remembering what? It's referring back to this low and this low because they're relatively equal. It does not know. Listen, folks, listen. Listen. It does not know your stop. It doesn't know my stop. It doesn't know how many stops. Your broker does. But the algorithm has no idea. It doesn't reference it like that. It just refers to these points, these PD arrays. So the market does what? It reprices back down below those lows, which is a discount, and consequent encroachment. They're all measurable. And there's no need to go back down to that low. Why? Because it's already repriced to the new week opening gap. And done what? The sell side has been purged. This is this returning back to a point of reference for smart money to accumulate longs. If they're going to buy here in their quote unquote smart money, and they are using what I teach as a market efficiency paradigm, that means they're going to buy stops that are below the market in the form of sell side, and they're going to distribute their long positions to buy side that's resting above the market. Willing buyers at a higher price. That's these stops right here. So they're buying sell side liquidity below these lows here, and consequent encroachment. They don't fear the algorithm repricing down here because they know it's already done its job. Big, huge step forward in your understanding about price action if you can see that. So if they buy here, and I talked about this live, it's not like I'm going back in time because it's already happened. I said this live here for you so that we can see it. The logic is real, folks. It's real. If they're buying that, what are they holding for? They're not holding for harmonic patterns. They're not looking for Elliott waves and all that other stuff. They're not counting waves. They're not doing any of that stuff. They're simply looking for the inefficiencies above the marketplace. Where is it in here? Nowhere. Here. We've already done that several times. Buying here, they're going to go exactly where I said it was going to go. The remaining portion of that 60-minute fair value gap up here that hasn't been traded to, once it went lower here, we've only delivered one time here. We went up to a quarter of it here, which is, again, not random. Then it went to halfway, consequent encroachment, and then ran through it. Like I said, that's where the buy side is. So smart money buys discount, sells to a premium. Buy stops at resting above here. They knew those buyers wanted to buy the market when it was down here. When they're down here, smart money, the paradigm shift that you're being taught to have in looking at price action, because it's algorithmic, is you're buying it here with the same mindset that they have. Smart money sees this as buying sell stops at the most opportune time. It's the precise time, folks. It's precise. You can't make it any better than this. The logic is right there. And buying that with the expectation of seeing it go where? Right to those buyers that want to buy high. Now, they don't want to buy high to buy a long position. They have they have a short, and they're holding on to their position here. Maybe there wasn't a lot of shorts. It doesn't make a difference because the algorithm doesn't know the level of float that resides above that. It means the number of orders. How many buy stops are resting above that high? I don't know. You won't ever know. The algorithm itself does not know. Buying it cheap, selling it to people that want to buy it higher. Why? Because I'm targeting their inability to know how to trade. I'm targeting their shield, their defense. I'm busting it in like the SWAT. I'm literally going through it. I'm teaching you how to do that. I'm sorry if it doesn't meet the nice feel that you think investing is supposed to be about. It's not like that, folks. This is war. And when you look at the charts, I have absolutely no moral conflict at all about taking your money or anybody else's money when you're on the wrong side of the marketplace, because you all sign the same risk disclosures when you open up your account. Everybody knows that you're likely to lose money. So if I'm buying down here, I'm doing what smart money's doing. I'm told you that that's what's going to happen there. From here, watch that. And we want to see it deliver up to this area again, but more specifically, the upper half. Why? Because it only went to here, leaving from this high up to the high shaded area here. That's not been repriced to. We only passed through one time here, then up to a quarter. So think about it like this. The range on that hourly fair value gap has been repriced to here. Right there at that moment. Then this high here takes it up to that level. So the remaining portion of that fair value gap, in my mind, I'm seeing that range left. I'm ignoring all this. So you're looking at all these things trying to guess which one I should have been looking at. I'm teaching you how to internalize it, because this is the part that the algorithm sees now. It doesn't need to look at all these other highs. This is the one that matters now, because it's traded up inside that old 60-minute fair value gap, but it's left in this portion of it where it has not redelivered to it. It's only been offered sell side. So the efficiency model is that price needs to trade up into that area and deliver price that way.